Joining us from Chicago shortly is George Dowd of Newedge USA. And we also are talking to Doug Cliggott of Credit Suisse. He's a U.S. equity strategist there. Doug, let me start with you on this GDP number. Worse than expected, and even though the first quarter was revised up, consumer spending worse than expected or revised down there. Does it pretty much illustrate all of your fears quite well?
Well, I think unfortunately, it does give a pretty accurate picture of where we've been, Matt, and that is a lot of growth in the United States in the first half of this year has been the result of building inventory. We had to do it. You know, if we go back to the end of last year, there was a real mismatch. Production was way below what we were spending. But we've brought that into better balance now at the end of the second quarter. And so we're probably going to migrate down towards that core rate of growth of consumer spending, which isn't very fast.
But there is still growth, though, Doug, isn't there?
Oh, absolutely.
Better than a stick in the eye.
It sure is. And I think, you know, for us, the big concern about growth isn't so much that we've slowed. It's the uncertainty around growth next year in 2011. I think what we're struggling with, what a lot of investors are struggling with, is what on earth are we going to do with the federal budget? You know, federal taxes are below 15% of GDP right now. Normal is something like 18%. And spending's almost 25% of GDP. So we've got this incredible mismatch between taxes coming in way below normal and spending being way above. You know, somehow we've got to adjust that and bring it towards equilibrium. But if we do it too fast, then we really do have concerns about sort of going to a very low or no growth environment.
Let me quickly bring in George Dowd from the Merck here and ask him what drove us to green arrows in the last hour of trading. I mean, with this news confirming everything that you were concerned was wrong with the U.S. economy, why did things turn up at 3 o'clock?
You know, I think a lot of it had to do with month end, and you know, look, you look at the way today's trade. I mean, the S&Ps have had kind of a hard time above this 1100 level. We're sticking pretty close to there right now, and so I just think it's more technical and position driven more than anybody looking at the GDP and thinking it's, you know, anything overly exciting or paints a new picture of the economy. And you look at the period that this GDP number covers, and it's fairly dated, you know, information. Right. So I don't think it really had yeah, I mean, so we have month end, then we have employment next week, and I think, you know, maybe the claims numbers out yesterday sort of give you an idea of what to expect on next Thursday with the claims again, and then the non-farm numbers on Friday. And I don't know, I think just in general you have a feeling that, you know, rates are going to stay low in the short end for a while, and we're going to have to see some improvement in the labor market before there's anything, you know, any kind of bump up in the rates.
Excellent point. We'll continue talking about that. And Doug, let me ask you, you know, what are we supposed to do here? You mentioned the deficit as a main concern, but I would think that jobs have to be the main concern, right? Corporations are sitting on so much cash and they're able to borrow as much as they want at super cheap rates, and yet they're not hiring anybody, and this continues to go forward. How long can we wait till November elections, till 2011? I mean, for a lot of people, it's a very, very tough situation.
It's an environment, Matt, that in many ways looks a lot like the 1950s and early 60s. You have to really go that far back to see a situation where corporate America was generating so much cash, where balance sheets were in very good shape, but they behaved in a fairly conservative manner. And we think the reason for this conservative behavior is uncertainty, and sort of uncertainty in a profound sense about, again, not only what our tax rate's going to be next year, but what's growth going to look like? What's the economic cycle going to look like? You know, no one running a business, honestly, no one managing money right now has ever done it in an environment that resembles the one we're in right now. There is just so much uncertainty in every direction you look. It makes sense that people are behaving in a very cautious manner.
Doug, it's Dominic here. I mean, here's the thing. It's not just the corporations, but it's the people, like you said here. But what are the catalysts that we need to get corporations to part with this, you know, some estimates $1 trillion worth of cash on their balance sheets? They talk about dividends, they talk about share repurchases, but no one's really doing anything about it right now, right?
Well, there are increases in dividends. There have been some, share buybacks, but I think at the end of the day, it's all going to be incremental, Matt, because I think the truth is a lot of managements feel very good about having a lot of cash on their balance sheet. A lot of Americans feel very good about having a lot of cash in the bank or in their money market funds. I mean, let's face it, the last 3 years have been really, really tough. A lot of unexpected things have happened. And so in many ways, it's just common sense that we're going to have a much more conservative, much more cautious profile to spending, whether you're talking about a corporation making a commitment to hire people or an American household making commitments for, big ticket items. I think we're in unfortunately, a very sluggish, slow, hopefully steady, but very slow growth environment for quite a while.
Now, Doug, let me jump in here. One guy who'd certainly like to get his hands on some of that corporate cash is old Uncle Sam. There's talk about taxes going up for individuals. I mean, is there any danger, risk, et cetera, that corporate taxes start going up as well to try to plug that deficit?
Well, when you look at corporate tax rates, our tax rates are here in the United States are pretty much at the top end of the global scale. So I'm not sure we're going to see any increases in the statutory tax rate. There could be taxes applied to certain industries. There's been a lot of discussion about maybe the financial services industry. But you raise a really important point. I mean, Uncle Sam is starved for revenue. And as I highlighted before, the mismatch between the tax take and what we're spending, it's 10% of GDP. I mean, it's simply enormous. So something's got to give. Somehow, some way, they need more revenue. Our only hope is that it's done in a way that in effect, doesn't destroy capital formation or have too negative impact on growth. It seems to us the logical thing to do is implement some kind of tax on consumption, but do it very gently and progressively, say over a 5, 7, 10-year period, and not just go after taxing income or taxing wealth.
Hey, George, it's Dominic here. I kind of want to ask you something here because we talked earlier in this week about how there was a call out of UBS saying that you should basically sell volatility. That is to say that the stock market's not going to really go anywhere between now and December. So basically play this range between 1,100 and a strangle, if you will, 1,100 to 1,200. Right. Is it going to be that, I guess, inert in terms of volatility, or do we see a pickup in volatility going into the third and fourth quarter?
Well, I don't think you have to be too brave to say you're going to see volatility go down as we get into August when everyone's on vacation. Normally that's the case, and it wouldn't surprise me to see it again this year. In general, is that the way we're going to be coming into year end? I think it's a tough call. I wouldn't be so bold as to say that we see it decrease. Maybe we stick around these levels, but I sort of agree with the previous guest that there's just a lot of uncertainty out there, and when you get that kind of uncertainty, you can get this increased likelihood that you're going to see large moves. So, do I have a real directional view between now and year end on volatility? Not so much. I think that August will probably be quiet, but then for the fourth quarter, I could see it going either way. And if I had to pick, I'd say maybe you see a bump up in volatility.
Hey, George, it's Adam. Real quickly, one trader today told me he's as afraid that the train has left the station as he is that the train's not even going to leave the station. That's that argument Dom's playing. What do you say to that?
The volatility train?
No, just the direction trade. He wants exposure to the upside, but he's worried it's going down too. It's like, you can't make up your mind.
Look, if you think you missed the up trade, I think that's, almost indicative of a top, right? So we've had a nice move up, but having said that, there's a lot priced into the market up at these levels. You look at the earnings we've had out, I think it's been 75 to 80% have announced better earnings. The S&P 500 stocks we've announced so far. And then we have a lot more earnings out next week, especially next Thursday. So do I think that a lot of the good earnings are priced into the S&Ps at these levels? Yes. And so if we have good earnings next week, I almost think you need that to stay up at these levels. And it wouldn't surprise me if we start to drift a little bit lower.
All right, hey, George, thanks so much for joining us. George Dowd of Newedge and Doug Cliggott of Credit Suisse.